Oh no, the market just pulled back. Oh my god, but why am I not worried? Because I have this. Welcome back to the channel. This is the Stock Estate, your financial bro. I'm an ex-financial advisor dedicated to bring you great content here on YouTube. Why am I making this video? Because I know many of you are scared. You know, you had dumped so much money, and with the market at all-time highs, you are just afraid of a market crash, and that is constantly on your mind. And yet, you know, you kind of FOMO at those potential gains that November has been giving, you know, market being rallying higher and higher and higher. It's confusing, I know. And I'm going to here to teach you one tip that will eliminate all of that. In this video, I will tell you what is that tip and what is my reasoning and analogies behind it. And let's get into it. Okay, what's up everybody? For my new subscribers, welcome. Type down in the comments section below what kind of video that you wish to see. And for my new viewers, subscribe, join our community of investors that plans for everything that we do. We plan our exit strategy, we plan for our trades, and for my long-term investments wise, we plan for what are the next big 10x stocks that we are going to actually pick. And to everyone that's watching, thank you. A like button will really help out the channel and encourage me to put out more content like this. Okay, and let me now review that few tips that are actually very important to me as an investor and as an ex-financial advisor as well. Okay, so a lead up to that, firstly, I'm going to talk a little bit more about emotions. Okay, so emotions, are the root of all evil. Okay, at least in the stock market wise. Okay, so, remember the number one rule, guys, we should not be too emotionally invested in our stocks. Okay, your mood should not fluctuate too much with the prices. Okay, if the stock goes up, you'll be like, yay, your stock goes down, you'll be like, oh my god, and you're in like a foul mood the whole day because you technically lost money on paper. Okay, fluctuations are very, very normal. Okay, so to combat this, when the market's up, okay, you shouldn't be too happy as well. Okay, it may sound a bit counterintuitive, but you shouldn't be too happy because those gains are unrealized gains. Okay, so likewise and same for red days. Okay, when you have massive red day and down, okay, you should not be too emotional and let it affect your mood too much because it's also paper loss. Okay, so if you are equally unaffected by both the highs and the lows, okay, then hence you'll not be too emotionally charged, and that will actually help lead you to make much, much better investing decisions because what you're investing in will be based on what your knowledge is about the company, price action wise as well, technical analysis as well, or what's the best time to, put in money at a stock. Okay, so this is just a preclude, emotions are always there, and it's very, very important to keep them in check. Okay, so this next one I'm going to talk about, the next tip I'm going to talk about is the most important one, which is the number one investing principle, which is keep your treasury full. Okay, so keep your treasury full. Okay, what is a treasury? Okay, treasury is what it is. Okay, so whatever money that you have put in the markets right now, okay, it's not counted as in your treasury because those are kind of locked in. Okay, and if you do not want to be taking money out when it's in the red. Okay, treasury means liquid funds, okay, that you can use at any point in time for anything such as emergencies, okay, for anything you need, like any emergencies that in your house that you need. If someone needs money very urgently, you can take it out. Okay, and also to buy stocks at a discount. Okay, this is to be prepared to weather any storm, and this actually leads to my previous point, which is about emotions. Okay, so we fluctuate up and down because there's a simple principle where when you're out of the market, okay, the market's red and you're happy. Okay, but if you are in the market and it's red and you're unhappy, okay, then if you are out of the market, okay, and the stocks go up, then you're unhappy. But when stocks are good, but you're out of the market, then you're unhappy. Okay, so that's a very mouthful. Okay, you can think about it through. Okay, so most of the time, this leads to a lot of fluctuations, especially when you're all in the market. So it's very important to leave some cash on hand. Okay, and especially when it's very uncertain or you have a very, very you're very afraid of the market being crashing soon, especially for this December where things are getting a little bit iffy. Okay, please leave some cash on hand for December. Okay, and as an ex-financial advisor, my treasury numbers are always around 10%. Okay, which I honestly think is really, really too low. But because back then, I was managing other people's money. So due to regulations, I cannot leave too much idle cash around. So it leaves around 10%. Okay, but now that I'm not in that industry anymore, okay, my personal one is actually leave around 20% cash for myself, because I feel like this is a very comfortable amount, and I know that, there's any huge market crash that comes, I have the cash and the ability to take advantage of that. Okay, and for those who are really, really bearish, right? Okay, you can actually, keep 30% cash on hand. Okay, so this links back to my previous point where this actually leads to, I'll be unfazed, or I will not be too emotional as I have no cash to fall back on, to take advantage of deals that are coming. Okay, especially those good and great companies that have potential to fall huge amounts, which you won't really see on a daily basis. This is my chance. Okay, and it really, really helps, some people sleep at night, because if that if anything happens throughout the night, I have cash to fall back on, if it goes up, yay, okay, my existing portfolio will be good. Okay, but if it goes down, I'm also kind of happy because I have cash outside of the market, which I can use to put in the markets and average down my costs, and also gains some good stocks at a great discount. Okay, but however, there's also a caveat, because I'm pretty sure you have already heard many of those what I said above. Okay, but with many different numbers. But here's what else I have to offer, which I would say is more precise. Okay, which I don't see a lot of people mentioning. Okay, which is not all red days are worth buying. Okay, not all red days are worth buying. Okay, it's not. Okay, you should not be buying on every single red day. Okay, these reserved market funds are for huge sustained sell-offs. Okay, and I'm talking about 20 to 30%. Okay, like percentage of around 20 to 30% sell-offs. Okay, huge sell-offs. Okay, it can be for a broad market index. It can be a potential company that you're invested in. Okay, so these big sell-offs are what those funds are for. Okay, like yesterday's drop, or a few days ago, a drop like around 2%, 3%. Those are nothing. Okay, those are nothing. Okay, those are just a drop in the bucket. Okay, those you shouldn't be too concerned about it, because you can take advantage of those 2 to 3% drops, okay, and pump in money, okay. But however, what if this turns into a huge and broader market sell-off? Okay, then although you might think that you might gain like a 3%, right? 3%, you get a 3% discount. Okay, but what if it falls even more? Another 30% after you buy. So instead of a plus 3%, you're at a negative 27%, and at negative 27%, you do not have any more funds to average down, and that is actually horrible. And that might as well you don't put money in your treasury at all. Okay, you'll find yourself running out of funds to average down, which is very, very common. Okay, I know a lot of people will say buy the dip, buy the dip. Any single time you buy the dip, okay? But if you buy every single dip, you definitely will not have enough funds, okay? Unless you are a super rich guy and you are selling, a lot of funds. You have a lot of funds in your account. Okay, but that shouldn't be the case if you're keeping around 20 to 30% and your 80% to 70% of your portfolio is already in the markets. Okay, yes, so you get my point. Okay, don't be too jumpy, be chill, as long as you have money in your treasury, okay, all will be good. Okay, so I leave you, with a very, very simple analogy. Okay, so let me just type it out. Okay, firstly is if it rises, chill and enjoy. Okay, so if your stock rises, chill and enjoy. Okay, next one. Okay, however, okay, if it dips a little, hold and do nothing. Okay, if it dips a little, hold and do nothing. Okay, just hold and do nothing. Okay, and lastly, if it dips a lot, buy the discount. Okay, you get my point. Okay, if it dips a lot, you buy the discount. Okay, so this is that 3-step analogy that I have. Okay, if it rises, chill and enjoy. If it dips a little, hold and do nothing. If it dips a lot, buy the discount. Okay, and that's about it for today. Okay, leave some cash on hand for the upcoming December. Keep anxiety low, be a smart investor, and I shall see you again in the next video. Stock and stay out.